Well, after surging in the spring, consumer inflation here in the U.S. may have peaked. The Labor Department reports Americans' cost of living unexpectedly fell 0.1% in October for the first time in 4 months. Meyer is the senior U.S. economist at Bank of America Merrill Lynch Global Research, and she joins me on set. Michelle, welcome back to Bottom Line. Always a pleasure.
Always great to be here, Mark.
Consumer inflation, has it peaked since early June?
I think it has. I mean, part of what's bringing down headline inflation is that commodity prices have turned lower.
Yeah.
So that's contributing to the negative number we saw today. Core inflation, which takes out the volatile food and energy components, increased by 0.1%, which translated to a 2.1% year-over-year increase. Now, I think that year-over-year rate is going to start to come down over the course of next year.
We were just talking about housing before we started the interview. Talk to me about the imbalance in housing and how that has in fact affected the core inflation rate, and secondarily, how hard is it going to be to keep rental prices from going up because they're on the rise right now?
That's the crucial question and component within core CPI that's probably going to put some upward pressure on the number next year. Rental components between rents and owner's equivalent rent make up 40% of core CPI, and there's upward pressure on rents now. The imbalance you speak of, there's a shift from ownership to renting, and there's not enough inventory for rentals right now, so rent prices are increasing, which pushes up core inflation.
Also with core CPI, we saw apparel prices pushing it up as well. But you're expecting apparel prices are going to level off or at the very least reverse course. Why?
Well, part of what brought up apparel prices recently came from high import prices, particularly from China. And I just don't think that's sustainable, especially in an environment where consumers are struggling so much with budget constraints. Yeah. Businesses are not going to be able to pass on higher prices to consumers in this environment. So I do think that apparel price pressure should start to moderate.
And we saw that yesterday with some retail numbers too. Folks like your Walmart's, not their gross margins not as high as they should be because they're not passing that on to consumers, but at least not yet. Today's numbers, do they give the Fed more incentive to stay the course right now? Because they pledged to hold the benchmark interest rate where it's at least until mid-2013. But that being the overall picture, can they keep that pledge? And is inflation a concern for the Fed right now?
I think right now the Fed can stay on hold, which means continuing an Operation Twist, which in a sense they're doing a backdoor quantitative easing.
Yeah, very much so. Yeah.
So then I think when that ends, the question is what do they do next if they do something? And that'll be a function of what the economy looks like at that point, which is the middle of next year. And I think core inflation will be coming down. Unemployment will stay close to 9%, which means there's a good chance we do see additional action from the Federal Reserve.
You expect fuel prices to continue falling this month. We see the average price for a gallon of gas, it's about $3.40, $3.41 right now.
I think, commodity prices have been so volatile. Gasoline prices have come down, but oil prices have crept back higher now. So that may end up translating to a bit higher gasoline prices, which would be a headwind for the consumer into the early next year. One of the reasons that retail sales in real terms have done better is because prices have come down on the headline number. If that reverses gasoline prices coming back up, it hurts consumer budgets.
And one of the other headwinds, this stagnant unemployment rate. It's been over 9 or at 9% for over 2 years now. And employees' wages, they are still flat. Given those two indicators right now, are consumers going to be able to sustain this level of spending, or is this an aberration?
I don't see how they can. You have exactly what you said, high unemployment, low income growth, and there's not much savings to draw on upon. One of the reasons that consumer spending is surprised on the upside is because consumers are taking down their savings rate. Yeah. That's not sustainable. There's not a very big cushion there. So I do think we should see a slowdown in consumption next year.
Michelle Meyer, senior U.S. economist, Bank of America Merrill Lynch Global Research, joining us on set. Michelle, it's always a pleasure. Thanks so much.